Hello, guys. Today we're going to be talking about organic growth versus inorganic growth of revenue. As you might know, revenue is the entire income of a company without subtracting any type of taxes or any cost of making the good or the cost of supplying the certain service. So simply, uh, the revenue of a certain company could have a lot of effect on how the stock price could increase, how investors could possibly feel about the certain company, and uh, the revenue in most cases during IPOs usually grows at a sustainable and normal pace, meaning it's not gradually growing very high, or it's not gradually decreasing at a very high speed. It's just a normal pace. In most cases, companies actually prefer to IPO when their revenue stream starts to stabilize. So when we talk about organic revenue and inorganic revenue, the first thing we notice is organic revenue is achieved by increasing output and enhancing sales. Always remember that. Only comes from the company selling its product, or you know uh, getting big deals and stuff like that. While in organic growth, uh, the growth happens due to mergers or takeovers. If we could possibly draw a graph here of a certain company, this is time, this is revenue, and if a company was growing at a fluctuating pace at first, then it started stabilizing, and at this point, this is the IPO point. When the revenue stream starts stabilizing, most companies give out an initial public offering. So after this, what happens is it starts growing at a very slow pace, but still a very reasonable pace. So that is organic growth of revenue due to sales and other big deals. But when there is a certain spike in the company's revenue, like the one I just drew, that's not because of organic growth. That is because of inorganic growth, which is due to, as you can see over here, mergers and takeovers. So, mergers and takeovers have a huge effect when it comes to inorganic growth, and it's not substantially a good indication for investors. We're going to be talking about that later. So, uh, let's go on to the next point. In organic growth, internal growth is required, while in organic growth, external growth, like I said, acquisitions and other type of deals, mergers and stuff like that are external growth, and internal growth are sales, anything the company does to increase its revenue. The next one is non-comparable growth. It is smooth and is not fluctuating at all. It's growing at a known pace as shown as a known financial model projection. The next in here is comparable because it's very noticeable, as you can see on the graph I drew right here. It's very noticeable. And the last one is this one is favorable for growth and investors like it, while this one is not because of the reasons I apprehended on the previous section. So researchers analyze organic sales growth by analyzing inorganic sales growth. Like I said earlier, inorganic growth is considered as faster way to grow when compared to organic growth. The little spike I drew just a moment ago is an example of that. So focus on investing on companies which have organic growth and don't be fooled with revenue streams that have inorganic growth. Notice this factor, and it could possibly be a huge factor when it comes to investing in stocks. So that was for today's video. Thank you. Don't forget to subscribe, like, and comment any suggestions. Thank you.